Thank you all for joining today. Welcome to July Presents Fiduciary Responsibilities Tips for Retirement Plan Sponsors. I'm Tommie Graszl. I'm a Senior Team Manager of Client Services here at July. Just a reminder, throughout the webinar, your microphones will be muted. If you have any questions, please use the Q&A box at the bottom of your screen. I'm going to go ahead and hand it over to Theresa to begin the presentation.
All right, thank you, Tommie, and welcome everybody today. We're happy to have you here. As Tommie said, we're going to talk about some fiduciary responsibility tips because fiduciary responsibility, of course, is something that is very important. Oh, my screen's not advancing. There it goes. So there's quite a few things we are actually going to cover today, but don't be overwhelmed by this list. They're just like one or two slides on each, but we thought that these were some very, very important things that you should be aware of, that you should think about when you think about your qualified retirement plan, and things that you should regularly look at. The IRS and DOL say that fiduciaries of plans should have regular training, right? So this would satisfy that kind of requirement, just giving you some basic reminders. And as Tommie said, we're happy to answer any questions that you have. Just put them in the chat. We're going to kind of stop regularly and see what those look like. So let's talk first about who is a fiduciary. Right? A fiduciary is somebody who exercises any control over the management of the plan or the assets, right? So that involves people who are part maybe of your retirement plan committee, executives potentially in the company, maybe your plan advisor. We're going to talk through that a little bit more. And that's where really number two comes in. It's somebody who renders investment advice for a fee or other compensation or has authority to do so. So that is often a financial advisor takes on some of that, and we'll break that down a little bit further as well. And then has discretionary authority or responsibility in administration of the plan. So that doesn't mean everybody who works on the plan is necessarily a fiduciary, but a lot of people who work on the plan are, and we'll go into that in a little more depth in just a minute. Let's talk next about kind of two types of fiduciaries. We're going to talk about administrative fiduciaries and investment fiduciaries. And there's two main types of administrative fiduciaries. One is what's considered a 316. And you may have heard that term, just like some of these terms. We're going to try to make it simple and break it down a little bit for you. But a 316 fiduciary is a service provider who's hired to manage the day-to-day administration. Now, not all of you may have a 316, but that option is definitely out there. That option is available. That option is becoming a lot more common in today's world because of the complexity of retirement plans and all the things you have to follow and all the things you have to do and all those kind of things. So having a 316 sometimes does make sense for somebody to oversee that day-to-day administration, maybe approving loans, distributions, those kind of things. And Tommie's going to talk about that in a lot more detail in a few minutes. There's also what's considered a pooled plan provider, a PPP, and that is a plan administrator and named fiduciary for a pooled employer plan, a PEP. So a PEP's kind of a new thing in the world. But if you are part of a PEP or want to be part of a PEP, there are definitely some out there. July sponsors one where a pooled plan provider does that 316 function. So it takes some of that off of you as the employer. So definitely more that we can talk about there. And that PPP is responsible for performing most of the administrative tasks for the plan, right? You as the plan sponsor or employer still have a responsibility to hire and to monitor these types of fiduciaries, but it does take some of that day-to-day burden off of you. There's also investment fiduciaries. So there are two types of investment fiduciaries as well. There's a 338 and a 321. We tried to break those down. Both are investment fiduciaries. Most financial advisors are one or the other. Some can function as both, depending on who they work for and what their agreements and stuff with you look like. But a 338, just to kind of simplify it, 338 can do the complete selection of investments for your plan. They're allowed to replace them without kind of your permission because you're hiring them as an investment fiduciary to do that service, right? To monitor, select the investments for the plan. A 321 is also a fiduciary, but they make those recommendations and work with you as the plan sponsor, as the employer, to pick the investments that will be in the plan. So in that instance, you're really working more in conjunction. It doesn't mean if you hire a 338 that you have no say, right? Typically, an advisor will talk to you about those decisions, but there are some distinct differences there between those, and you should talk with your financial advisor if you have any questions about that part of how they function for you. So let's talk about, I have two slides here. This first one is about who is working as a capacity in the capacity as the fiduciary, and our next slide will be who is not. So who's working in the capacity is somebody who is the actual sponsoring employer. As a business owner, I would be the sponsoring employer. I would be a fiduciary. If I am on the retirement plan committee that is named in the plan document, I am a fiduciary. If I'm making key decisions, if I'm providing investment advice or selecting investment options like we talked about in the 338 and 321, I am a fiduciary. So those are the people who are definitely fiduciaries in your plan. There are some people who are not fiduciaries. So those might be somebody who's in your human resources department who may just be helping participants by determining who's becoming eligible, maybe helping get notices out and other communications to participants, maybe maintaining like the records, right? The compensation stuff, the things that we need as the administrator of your plan, as the TPA, to do the compliance testing, or giving us the dates of birth and hire and those kind of things, right? Maintaining those types of records. That doesn't necessarily make them a fiduciary, right? If they are just providing kind of service to that. So there is a distinct difference. One of the things I did want to tell you is that sometimes those lines can be a little blurred. So I would make sure you have a distinction there on who does what, who's named in the document, who's truly a fiduciary and who's not, right? Because sometimes you may put somebody in your HR in the position that they may be making a decision that's really not theirs to make and kind of making them a fiduciary when you don't really mean to. One final slide I'm going to go through before I turn it over to Tommie to talk a little more about a 316 is a fiduciary file. So all of you should have a fiduciary file. And that contains some of the records that you would need, right, to prove that you've done regular things. If you ever do get audited by the IRS or Department of Labor, right, you would want to have these things in your file and keep them updated. A lot of times, the financial advisor will help you with some of these, particularly when it comes to the third bullet down there, the investment policy statement, the 404C compliance. That's places where your financial advisor will help you. The plan document, we help you get that, right? You have a copy of that. There are some government and regulatory requirements like filing your Form 5500. Those should be part of your fiduciary file. ERISA bonding, you should have a bond. Payroll information, the census you provide to us each year should be kind of part of that file. Participant communication documents, we're going to talk more in depth about notices and things like that that you provide to participants. Those are very important for you to keep, because if you have to prove that you handed those out, when you did, a lot of times your record keeper can help you with that, whether that's July or somebody else, right? So that can work. Third-party service provider. If you have a third-party service provider, somebody like July, you want to have the information about them, their notices, right? They provide you what's called a 408B2, which is a notice of the fees that are charged, those kind of things. And your committee meeting information. Now, not every retirement plan has a committee meeting or has a committee to oversee that. And I'm going to talk in a little bit about why I think that is important to have that just for some of that. But those are the things you should have with your committee meeting information. If you do regular meetings with minutes, things like that, all that should be part of your fiduciary file. Tommie, why don't you talk a little about 316 and then we'll stop and see if there's any questions.
Thank you. Yes. So this slide here we prepared, this is what we present to our clients when they're joining our platform and they start as a 316. where we're the 316 provider. So there's a number of items here that we take care of as the 316 provider. If you do not have a 316 provider, as she mentioned earlier, you would be responsible for most, if not all, of these items here. So number one here, preparing plan documents and signing amendments. So all of our clients, we prepare the plan documents for the most part, but we also sign amendments. Obviously, you'll be making the decision related to eligibility and things like that, but we're the ones that will take care of the signatures. You don't have to go out there and sign it. And then obviously we'll, transitioning into the second point here, we'll maintain your plan records. We're going to make sure that we're maintaining compliance testing, signatures, 5500s, all types of things like that. So you should definitely keep a copy regardless, but we will have, kind of a backup there for you guys as a 316. Obtain fidelity bond. So this is a requirement, and what we'll do is we will purchase that fidelity bond for you and pass along that invoice. But we do make sure that you have a fidelity bond. You're in compliance there, and you don't have to worry about anything if the plan is audited. Oversee plan vendors, approve invoices, think like custodians here. So custodian invoices, approving custodian vendors that are holding the assets of the plan, just, overseeing them and making sure that everything's in good order there. Calculating and tracking eligibility. This is a big one. We take care of calculating eligibility, sending, emails. This is who's going to be eligible, and even sending emails directly to participants that are going to be eligible, telling them, here's how you enroll in the plan. So just making sure everyone has an opportunity to enroll in the plan, and we don't have any sort of, issues where you did not give an employee the opportunity to enroll, and we have corrections and things like that. Um, Calculating employer contributions and forfeitures. So, part of our compliance testing process is calculating employer contributions, making sure contributions are funded properly throughout the year if that's how you do it. So, your safe harbor matches, your discretionary matches. If you're funding that each payroll period, making sure those are coming through properly. And then at the end of the year, making sure everything was calculated correctly. If you're doing a profit sharing, we'll make sure that that's allocated and work with you to allocate accordingly, however you would like, dollar amounts and things like that. Forfeitures, if there are unvested dollars in the plan, say a profit sharing or discretionary match source that follows a vesting schedule, we'll kind of monitor those forfeitures and make sure they're being used. Fairly quickly. We want to try to get them out in the following plan year, use them to offset plan expenses or use them to offset employer contributions. So we kind of keep an eye on that so you don't have a forfeiture balance that kind of carries forward over multiple years. Integrating payroll with your payroll provider. When possible, we try to integrate payroll. Uploading a file to our website can be time consuming. So if we can integrate payroll, we do try to do that frequently, just so you don't have that administrative, duty. And if you're typing something in a spreadsheet, you could make an error and things like that. So we do try to integrate payroll. But if we can't, or even if we do, we make sure we monitor timely contributions. Definitely a big one, making sure contributions are funded timely. I know there's another bullet point on a later slide about that, but getting those contributions as soon as administratively feasible into the plan. And if you're a smaller plan under 100 employees, generally, you do have a safe harbor of around 7 business days to get those contributions deposited. But the larger plans, it's a little more restrictive as far as when you have to make those deposits. If they're not made timely, you're running into lost earnings and a corrective form, and even opening the plan up to audit potentially because of your late contributions. Preparing and signing the Form 5500. I'm sure many of you are familiar with this process. If we are not your 316 provider, you're going and signing your 5500. We are preparing it regardless. As the 316, we go ahead and take care of that and just sign it for you. So you don't even have to worry about it. It gets done, it gets signed, we make sure it's timely. So we kind of take care of all of that. Managing and improving distributions and loans. So when participants submit requests, it's possible we could have some additional follow-up questions, and we may reach out to the participant or the plan sponsor. But for the most part, they submit the request, we go ahead and approve it and process it, and it's just something you don't have to worry about. Prepare notices and deliver notices. We also discuss this in detail on later slides, but this is a big one. It's time consuming. We prepare notices for all of our clients, but the delivery part is the challenging part, getting those notices to participants. We take care of all that. We ask you to send an initial electronic notice to participants telling them, hey, all your emails will be electronic going forward unless you opt out. And you want them mailed. If they do that, we will mail them. Otherwise, we will email all the notices. We'll email them timely, and it's just something you don't have to worry about. We'll have all that documentation. We also hold an annual plan review. So we go through many of the things I just discussed and say, here's your checklist, here's your fiduciary checklist, here's all the things that we did throughout the year. Everything's in good order. Or if something, maybe you had late contributions, we'll mention that and correct it accordingly. So these are all the things that we do as a 316 fiduciary. If you currently don't use our 316 fiduciary services and you're interested, certainly reach out to your client service manager. There's some minor restrictions as far as plan design, but the cost is very reasonable for the amount of these items that it's taking off your plate.
Yeah. And I talked earlier too about how it's becoming way more common to use a 316. So it does take off some of that administration. Again, you as the employer plan sponsor have a responsibility to oversee and monitor, right? So, that's still out there. So it doesn't completely take off all your responsibility, but it does limit it, especially when it comes to these type of tasks. So we don't have any questions in the chat yet. So I guess we'll just keep on going then, Tommie.
Okay.
Okay. Okay, so I'm going to talk a little about committee meetings because I think that as a fiduciary, sometimes it is better versus having one name fiduciary to possibly have a committee. I know some of you might be very small employers and maybe this doesn't make sense, but if you're a little bigger employer, it's definitely something that you might want to consider if you're not doing it already. And as being part of the committee, it kind of spreads some of that fiduciary responsibility around. You would have a charter. You would, when you did your meetings, you would have minutes that you would, be able to rely on, things you may want to talk about, probably a regular type of set agenda of things, you may want to include things annually. And committee meetings, I guess I should also say, can be held any variety of things, like some are annual, some are twice a year, some are quarterly. Probably, again, that might depend on your plan size. Work with your advisor on that, how that's going to work. But having minutes, having an agenda, having some regular things you talk about, the investments, right? The enrollment and the outreach to participants and how that's working. There are definitely other things you should talk about. You should probably do, maybe not annually, but I know some people do annually, review the costs of your plan, right? And it's not all about cost being the cheapest. It's about what we're getting, what services we have. Does that make sense, right? And doing that sort of review is not necessarily a bad practice to have. And it's something you may want to look at. Again, I kind of think every year is a little overkill, maybe every couple of years to do that, but definitely something you might want to consider. The other thing I would tell you, part of that committee meeting, maybe, having some sort of plan procedure. What are your enrollment procedures? Who's handling that? What are your loan and hardship procedures, right? What's happening with that? If you have a quadro, which is a qualified domestic relations order, when somebody gets divorced, they have that. What's the process for that? And other forms that are related to the plan administration. You may also want to have like copies of your notices that are going out and look at those. And, there's a lot of moving parts when we're talking about a qualified plan. So having a committee that can kind of review those regularly, If we're 316, we would help with that. The advisor will help with that. Those are kind of things you should be looking at. And I would tell you should be doing that at a minimum annually, right? Doing some sort of meeting like that. I just love this slide. I keep it in all my presentations. So sorry, it's just one of my standards. It's the prudent man role, right? The biggest thing about being a fiduciary is you really have to make sure you are working solely in the interest of those participants and beneficiaries. That's what the Department of Labor is particularly interested in, that we are putting participants first, that we are providing them information about the plan, that we are doing the right things when it comes to participants. So that's one area where really that's where this prudent man role really comes in, right? It's challenging sometimes. I mean, that's, I think, why he has the glass of champagne there, right? But definitely something you should consider. Okay, Tommie, I'm going to let you go on and talk a little about managing data and plan provisions and those kind of things.
Yeah, thank you. So yeah, managing data, as a fiduciary, you have a responsibility to protect participant data. We mentioned cross-selling products in here. None of us like to receive those spam emails because, we entered our email on some website. And now we're getting a bunch of emails that, we don't want. So, as the employer, just making sure that you're protecting that data and not, providing that data to, sources that are going to do things like that. Obviously, at July, we would never do something like that. But you have other providers as well. Just making sure you're protecting this data. Identifying information, names, socials, dates of birth, all their personal information. Obviously, financial information, contribution history, account balance. Even investment preferences. I'll also add. To this, just ensuring the appropriate parties at your office have access to the information. You shouldn't have too many people that have a login to your retirement account. Obviously somebody that's uploading a payroll file, but you don't want to have too many people that have access to all this personal information. And you also want to make sure you're maintaining that access appropriately. If an employee leaves, you want to make sure that you're telling your providers, hey, shut this off. So just, making sure that you're being careful with all that information and all this personal information here. And let's talk about managing plan provisions. So the first one here, eligibility. Obviously, you can be less restrictive than the law allows. So, age 21, 1 year of service, and dual entry. So generally, you have your January 1st and July 1st. You can be less restrictive, and that's fine. But you also have to be careful. Say we have 60-day eligibility and immediate entry to the plan. Well, you might have employees entering the plan throughout the year, so you have to make sure you're monitoring that. You don't have those two entry dates. It could be at any point during the year, so you have to track that 60 days. So just important that, okay, we want to design our plan this way. We want to be less restrictive, but let's make sure we can administer this properly and we don't have any errors. Vesting. Obviously, a record keeper and a TPA is going to take care of your vesting schedules and calculating vesting. But as a plan sponsor, just making sure, if you're approving a distribution, everything seems right. What data did you provide to the TPA to July during the year? Did you just plug in 1,000 hours on that year-end census and the employee worked 500? Well, that's going to impact vesting, and they might get paid out more than they should have if they take a distribution. Again, participant contributions, just making sure that they're deposited as soon as they can be reasonably segregated from the employer assets. For your smaller plans, you exceed that 7 business days, you have lost earnings. It's called a Form 5330, an excise tax, and you could subject the plan or open up the plan to, audit. Maybe you're going to be on the IRS or DOL's radar once you have those late contributions. So just making sure that those are uploaded timely. If the plan is audited, I can assure you this is something that they're going to look at. They're going to make sure your contributions were uploaded timely. Distributions, just making sure you're following the plan document, and just making sure your loan provisions are in good order. Everything's paid, paid must be repaid at least quarterly. Generally, these come out each payroll. Just making sure loan payments are being processed, and making sure for distributions you're following the plan document. In-service distributions, hardship distributions. um, are you following the document? Don't just approve to approve. Sometimes I hear, it's their money, so they should be able to take it. Well, it is, but they also need to make sure you're following the plan provisions, and you're not getting the entire plan in trouble because you approved a distribution that you shouldn't have. Non-discrimination testing, July, obviously we will take care of all your compliance testing, non-discrimination testing, but timeliness is important too. ADP, ACP refunds, making sure they're processed timely, and just making sure you're staying within the annual addition limits, and not over contributing where you have a deductibility issue for tax purposes. And then lastly here, just compensation, ensuring that proper compensation is used. Um, if you're uploading files to July, make sure you're using the proper compensation amount. This is a challenging one too. I mean, it's a common error. You have a definition of compensation in your document that you need to follow, and it's again certainly targeted by the IRS if you happen to be selected for audit. They're gonna question the compensation you're using, look at the plan document, make sure that you're using that proper amount for contributions. And you have some potential issues if you're not. So if you have questions on that, obviously your payroll provider can assist, your accountant, and July as well, just making sure that you're using the proper compensation. I have a couple slides here for major plan deadlines. I won't go into too much detail on these, but first you have your March 15th deadlines. Depending on your entity type, if you're not filing an extension, you want to make sure your employer contributions that you're deducting on your tax return have been funded. Um, if you file an extension, you have to a later date, but just make sure, if we took a deduction, let's make sure it's funded by that date of March 15th there for S corps and partnerships. Another big deadline here, ADP refund deadline. So if your plan is not a safe harbor plan and subject to the ADP or ACP test, you have to compare the contributions of highly compensated employees to those of non-highly compensated employees. If the highly compensated employees are contributing a greater average, generally 2% greater, um, refunds may be needed, and you want to make sure they're processed timely by March 15th. Failure to do that, and you're running into excise tax issues. And again, another form that you have to file to pay that excise tax. Um, April 15th deadline, that's the one we're all familiar with for our personal returns, but for employers, you have your sole props and C corps. That's your funding deadline, same as the March 15th deadline. There is an extended deadline for ADP refunds if you have automatic enrollment, an eligible automatic enrollment contribution arrangement in your plan. Just to encourage automatic enrollment, the IRS they extended that deadline. So you have a little bit of a grace period there till June 30th to make sure those refunds are processed. July 31st, that's a big one, your Form 5500 deadline. I'm sure most of you are familiar with the Form 5500, the financial reporting. July 31st for a calendar year end, that is your deadline. We can extend that deadline as well, and I have a slide on the next slide. That date is listed in here. A couple more deadlines here. So September 15th, that's your extended deadline for your partnerships and S corps. October 15th, sole props and C corps. Again, just making sure if you're deducting those contributions on your taxes, you're funding those to the plan by that date. September 30th, you have your summary annual report. This is just a summary of the financial information on the Form 5500. It has some additional text and disclosures. You're required to distribute this to each plan participant every year. So if you did not file an extension, September 30th is that deadline. October 15th is your final Form 5500 deadline. Anything after that date, you're going to have to go through a corrective program to pay a reduced fee, or you potentially run the risk you're going to get a letter from the IRS or DOL saying you owe a significant fee for those late filings. So just making sure everything is filed by October 15th, very important there. Then I have December 2nd here. So there are a number of required notices that we'll go into detail on the next couple slides here. But these do need to be distributed 30 days prior to the end of the year. We've listed a few here and we'll go through these in detail, but you do have to distribute all these notices to plan participants by that deadline. And then lastly here, just December 15th, that's your extended deadline for your summary annual report if you file an extension on your 5500. And so here's some of your annual notices that you're going to see. There's a lot of notices that you have to distribute. There's a lot of pages in these notices. That's why I mentioned earlier about the administratively, it can be burdensome to have to distribute all these notices, whether you're printing them off and mailing them or handing them to participants. There's a lot there. So the first, just your 404A5 fee disclosure. This is your annual participant disclosure. It's as listed here, if they can direct investments in the plan. So this is going to have your investment options and all the fees that participants might be subject to, investment related fees to mutual fund expenses. So everything's listed there in that notice. QDIA notice, so your qualified default investment alternative notice. If you have a default investment in your plan, a qualified default investment, you're required to give a notice. So if a participant doesn't select their investments, they will go into this QDIA and you're required to give a notice to those participants. Safe harbor notice. So if your plan's safe harbor, you have a number of exemptions as far as testing, ADP, ACP testing, top heavy testing to a certain extent. It really allows for owners and others to max out their deferrals for the year, not have to worry about those refunds. Well, one of the requirements, you have to send out this notice. It's a requirement that you must send out this safe harbor notice. They have laxed the rules a little bit with the non-elective safe harbor, notices, but generally for your match, you're still going to have to give this notice out. Automatic enrollment. Does your plan have automatic enrollment? Well, we want to tell these employees, hey, if you don't enroll in the plan, you are going to be automatically enrolled in the plan. That's why we have this annual notice that must be distributed before an employee becomes eligible, and then annually. And then lastly, just your summary annual report that was mentioned previously on the previous slide.
And then some of the special notices. So what Tommie was talking about on the last slide was the kind of the annual notices, the things that you have to give out every year for the most part. And there may be some additional that we did not include. We really tried to include the kind of top ones that we see given out. And then these are some of the special notices. Again, this is not an all-inclusive list, but just some of the ones that we see most frequently. The blackout notice, right, that you have to give out 30 days before the beginning of a blackout period. That's maybe when you're moving vendors, when you're moving record keepers, right, when you're moving your plan from one company to another. That's that notice that must be given out. Summary plan description, right, must be distributed within 100 days after the plan is established or when people become newly eligible. There are some rules about when the summary plan description, but that's the lesser piece that talks about some of the bigger plan provisions that a participant gets to see, right? They can see the whole plan document, but they're not going to read that. And so the summary plan description really talks about that. Summary material modifications goes along with plan documents. So if you make an amendment to your plan, right, and you don't redo the whole summary plan description, you can just give out this summary of material modifications that talks about the change that was made to the plan, the amendment that was done, right, and it must be furnished within 210 days after the end of the plan year in which you adopted the change. So they have a long time to do it, although we usually recommend after you make that change that you get that out pretty quickly, because otherwise you forget about it, right? 210 days is such a random number after the end of the year, but that's what the rule is. But getting it out earlier is always better. Notice of discontinuance of safe harbor. I know this sounds like a crazy one, but especially during COVID, we had a lot of clients stopping their safe harbor contributions, and just something you do need to be aware of, that you do need to, if you are thinking about doing that for any reason, you would have to send out a notice, and you cannot stop the contributions until 30 days after participants have received this notice. So just some of the more kind of special ones for you to really think about. And there's definitely more that are not on this list. I'm going to take just a minute here to talk about some common administrative errors that we see, and things that you should definitely be aware of and think about. And if you need help, again, reach out to us. We can help you with those. But following plan document, I see that as one of the biggest ones, right? That you don't follow the plan document, or you hire somebody new in the HR department and they don't really understand what that is. And that's one of the things that happens, right? Or also communicating any changes, getting out that notification. Hey, we added auto enrollment, or hey, we added safe harbor, or we added whatever, right? Communicating those to your participants is very, very important. We see participant eligibility errors where people are not let in when they actually become eligible. And that can happen a variety of ways. One, it's Tommie talked about it earlier. Like if you have a lot, if you have monthly eligibility or something like that, it gets a lot harder to monitor and get people in when they should get into the plan. And we also see it a lot with automatic enrollment, right? Where you add automatic enrollment, and a participant should come in, at the beginning of April, and you forget about it, right? Or your payroll doesn't add it correctly, or any of those things can happen. And that's where we see eligibility errors. And there are ways to correct these errors, but sometimes those can be costly. So knowing those rules and getting them done when they're supposed to be done is very important. Loan and in-service withdrawal failures, and Tommie said it earlier as well, it's the participant's money. We get that, but the IRS is quite restrictive on when participants can take their money. It's supposed to be a retirement plan. It's supposed to be out there. I actually just had a conversation with a friend who got a divorce, and he's like, I had to pay this money to this quadro attorney. And why? I was like, because in a retirement plan, it is restricted on when money can come out of the plan. So, we have to follow those rules. We will help you follow those rules. And those kind of things. But, those things do happen, or participants stop paying on their loan and then it needs to become taxable. So there's a lot of different things that can happen there. Compliance testing errors, failed your ADP ACP test and we didn't correct it timely. If it doesn't get corrected by the March 15th date, because you're late getting your census or whatever, right? There are rules, and the penalties aren't that much as long as you get it distributed in the year. But it's when you go past that it does become, nobody did your testing or something else happened, or we see that a lot in plans that we take over, those kind of things. Same thing with top heavy failures, right? Plan being top heavy. And just for clarification, an ADP test tests the current contributions that are made this year, whereas a top heavy test tests the account balances. And we don't see a lot of top heavy failures in today's world for the most part, but every once in a while we come across one, and every once in a while something happens, and those kind of things. And when there is a top heavy failure, there is an additional contribution that the employer has to make. So that is something that can happen. Again, it's something that can become costly. And 415 failure is the amount of contributions participants are putting in the plan. And, sometimes they go over a limit, particularly when we're talking about highly compensated employees or things like that. So just things to be aware of. These are things we help you monitor, but some of those you have to be aware of as well, particularly when, we're not the 316 or things like that. Okay, before we kind of go, Tommie and I have some case studies. Again, if you have any questions, please, now is the time to put these in the chat. This is our last slide before we get into some of the case studies where we're going to talk to you about some of the things. So we'd be happy to answer any of your questions. But how to meet your fiduciary responsibilities, because that's what this is about, right? One is to identify who your fiduciaries are, and we talked about that earlier. Be clear on who those are, know who those are, and understand, maybe you should have that committee to help with those fiduciaries and get them trained. Make sure they know they're a fiduciary. Going through a training like this would satisfy the requirement, and is something that should happen. Your financial advisor can also do some of the training. So things to think about there. Provide investment and plan information so they can make informed decisions. That's where all those notices come in. I know those notices are a pain. They're one of the things that got added a few years ago, and they're one of the things that I know plan sponsors complain about. Hopefully some of it's a lot easier, with getting some of those out electronically instead of printing all that paper, but make sure participants know and are getting the information they're required to get. One of our case studies is going to talk about that particular issue. Make sure you're depositing participant contributions regularly. Tommie talked about that. There are some definite rules that those have to be contributed. I know that we get a lot of correction work that we do because of participant contributions. And a lot of the times in my mind, it's not the regular person who does it. It's that regular person who quit and now you have somebody new and they don't know the rule, or it's that person's on vacation and now nobody else picked that up and you don't realize it. And a lot of times you don't realize it for a few months. And so those kind of things definitely happen. Make sure you have a procedure to hire and monitor your service providers, right? We talked about that a little bit. You still have a responsibility to select and monitor those people. Again, look at maybe costs every couple of years, make sure, all that's reasonable. I think in today's world, mostly it is, but again, something you should go through and look at. Be aware of parties and interests. So this is a kind of interesting one, but the example of this is, right, that you don't have somebody like your brother-in-law, maybe, who's your financial advisor or something like that, right? They could be considered a party in interest, right? And so are you giving them a business because they're the best choice because you selected them? I mean, any number of things can kind of affect that. So make sure that you're clear, and as a fiduciary that you're making those decisions. Make sure you're following that plan document. Please make sure you're following that plan document. That's such a big one. So nothing else we can say there. I think we've said that a bunch of times. And bonding, right? There's a fidelity bond that you should have on your plan assets. And as a fiduciary or having a fiduciary committee, there is also fiduciary insurance you can buy. And that does help protect the plan and the responsibilities there as well. So just some of the things you should definitely think about as you're trying to meet your fiduciary questions. We did get one question, and our copies of the slides going to become available. Yes, we will have those posted along with a recording of this. Will be on the website in a couple of days. So give us a couple of days to do that for sure. Okay, Tommie, let's go to our first case study. If I can get the screen to move, and I'm going to let you handle this one.
Yeah, thank you. So case study number 1 here. So this is an actual example of something that really happened here. And it's related to compensation. That's a big one. If the plan is audited by the IRS, they're going to look at compensation. So here's what happened. So the client provides an annual bonus to all employees each year, including the owners of the company. Fairly common. Bonuses are not excluded from compensation for retirement plan purposes. Again, this is fairly common. Usually bonuses are eligible wages. You can certainly exclude them in the document, but for the most part, they are not. They are eligible for 401k deferrals and match and, so on. So the owners, they elected to make 401k deferrals from their bonuses. No other employees elected to make deferrals from their bonus. So, so far, all right, we're okay. Like nothing really done wrong. But they did get a letter from the IRS so that they were audited. So the IRS, they're looking at, okay, why did these owners defer from their bonuses, and why didn't anyone else defer from their bonuses? Did you give everyone an opportunity to defer from their bonus? Well, they didn't have any documentation. They just let the owners defer from their bonus, and no one else really had that opportunity. So what the IRS did, they said, all right, well, you have to correct this. That's a 50% employer contribution on what would have been deferred on the bonus and 100% of the employer match that they were making plus lost earnings. They also opened it up to multiple years. So it wasn't just this one year where they had a few $1,000s in bonuses. It was 3 or 4 years and a pretty lengthy calculation. You're looking at multiple years of lost earnings. Um, so it ended up being pretty costly for a client that thought everything was in good order. I think the lesson here is one, our bonus is excluded from your plan document. If you don't withhold from bonuses and that's your standard procedure, that's generally fine. Just document that procedure. We don't withhold from bonuses. And more importantly, inform your employees, hey, we have a bonus coming up. We do not withhold from bonuses. If you want to withhold, let us know. If this client would have done that, they would have been okay. If you do withhold from bonuses, a little less risky there, because it's automatically going to happen. But, best practice, I would say, let your employees know, hey, just if you don't want this withheld from your bonus, let us know before we run this payroll. So this is something that I have conversations with clients about this all the time. So it's definitely a common one, and I'm sure there's many, plan sponsors that don't realize, they're not doing something correctly.
Well, and I think, Tommie, you're exactly right, right? I think compensation is one of the hardest pieces, right? What's included, what's excluded? Is the payroll company doing it right? Did they calculate? So I think there's a lot of pieces there that can go wrong, honestly. So I think compensation is definitely a big one. And I'm sure we could tell many other stories where that happened,
Right.
but okay, our case study number 2 is about a safe harbor notice. So I think notices are a big one too. So we have a client who had 150 employees and a 30-day eligibility, but only 3 participants were deferring into the plan, the owner and 2 other highly compensated employees, and the employer is making a basic safe harbor match. Did the plan sponsor send the proper notices? If under audit, they would need to be able to prove that. Again, back to Tommie's point, is that, they would need to be able to prove that they did send those notices or that their service provider sent those notices, right? Because if they don't, they do have to make up that safe harbor match. And again, that correction is 50% of the missed deferral plus the safe harbor match. So it can be very costly. I've had a couple clients that have had this happen. And I think the other thing I'd bring up to you is that, right, we put participant counts on the 5,500. That is one of the questions. That is sometimes how I think the IRS sees that, right? If they see 150 eligible employees, but only 3 people with account balances, that's going to look a little funny to them. And it might be true. Don't get me wrong. It might be true, but particularly if you have a safe harbor match, you need to be able to prove that they got those notices, right? And that really did happen. Otherwise, you may be in a similar situation where you have to make up those contributions. So just definitely something to think about. Make sure notices are going out. I think notices are going out more now because service providers are helping with that. And it's not such a big lift, but it still is something you need to consider. Okay, and our final case study is about a controlled group. So I like to just talk about this because I think sometimes you don't realize sometimes when something happens, in today's world, there's a lot of merger and acquisition stuff going on. So, think about I'm buying another company or something else is happening, right? We had 2 employers who are operating independent qualified retirement plans until 2019. In 2019, they came under common ownership. So they became what's called a controlled group. In 2020, they had to be tested together. Well, they had different matches. One had a safe harbor match of $100% of deferrals up to 5% of compensation. And the other had a discretionary match, which was 50% of deferral up to 6% of compensation. So the fact that they became this control group now means they need to be tested together. And now we have these different match contributions going on. We have all these highly compensated, all these non-highly compensated. So we have to now test them together for a lot of their testing. Coverage, ADP, ACP, even an average benefits test, because we have different levels of comp and we have to make sure these pass. And if that fails, how do we fix that? Well, probably by giving those employees who got the lesser match bringing them up to that higher match level. So again, something that can be costly, but something if you're prepared, or let us help you when you have something like that, let us know, notify us, let us help you work through that, because we don't want it to cost you later or for us to discover it later. And this particular client, they didn't come to anybody about it until this year. So now we had to go back and test 2020, 2021, and 2022, and 2023, and make sure all that testing passed. So, and if not, that was an expensive correction for them. So just again, my thing here is let us know when things like that are going on in your business, because that can really help. Okay, our final slide is just a reminder of your fiduciary responsibilities. Act for the exclusive purpose of benefits, providing benefits and paying reasonable expenses. And again, this says reasonable expenses. It doesn't have to be the cheapest. It doesn't have to, right? Free is not always the best thing. So just make sure that you're reasonable, you're within a range. If you have proof that you looked at that every couple of years, if you did get audited, there would be no question that you did your due diligence. Be that prudent expert. I showed you that slide about the prudent man rule, right? Make sure you're acting in the best interest of prone participants. Monitor your service providers. Disclose by giving your notices. Act in accordance with the retirement plan document. Don't engage in prohibited transactions. I don't see a lot of that anymore, but we do see that sometimes. So just something to think about, and make sure you have really, good review of those retirement plan investments, right? And make sure they're diversified. Again, something your financial advisor can definitely help you with. All right, so we have a few minutes. If we did have any questions, we could take them. Tommie, anything else you wanted to add?
No, that is all I had. Thank you all for your time today.
Yes, thank you for being here. We appreciate you letting us share with you for 50 minutes. So perfect. All right. There's no questions. Thank you, everybody. Have a great
Thank
rest of
you.
your day.
Bye.